Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TransDigm Group Incorporated quarterly report. TransDigm Group Incorporated offers a diverse range of businesses and services across various segments. In the power and control segment, the company provides aircraft components such as mechanical/electromechanical actuators and controls, ignition systems, specialized pumps and valves, power conditioning devices, and electronic components. The airframe segment is another significant area of operation for TransDigm Group Incorporated. It offers a wide range of products including engineered latching and locking devices, cockpit security components and systems, thermal protection and insulation products, lighting and control technology, parachutes, and testing and instrumentation solutions. In addition to these segments, the company also operates in the non-aviation segment, which provides seat belts and safety restraints, mechanical/electromechanical actuators and controls, hydraulic/electromechanical actuators and fuel valves, refueling systems, and turbine controls. The company serves a variety of customers including engine and power system suppliers, airlines, military buying agencies, airframe manufacturers, off-road vehicle and subsystem suppliers, satellite and space system suppliers, and heavy equipment manufacturers. Overall, TransDigm Group Incorporated's diverse range of businesses and services makes it a significant player in the industry. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause a stock's price to remain stagnant over a period of time. The stock market is inherently unpredictable, and there are numerous factors that can contribute to a company's stock price remaining unchanged for an extended period. One possible reason is a lack of significant news or events that would impact the company's financial performance or industry trends. This could be due to the company's stable operations, consistent revenue growth, or its position in a mature market with limited competition. Another factor could be the overall market conditions. If the broader market is experiencing a downturn or volatility, it may affect the stock price of individual companies, including TransDigm Group Inc. Additionally, changes in interest rates, economic indicators, or regulatory policies can also impact investor sentiment and influence stock prices. Furthermore, a company's financial performance, such as its revenue growth rate, profitability, and debt levels, can also contribute to stagnant stock prices. If the company is not meeting investors' expectations, or if its financial metrics are not improving, it may lead to a lack of interest in the stock, resulting in no significant price changes. Lastly, industry trends and competition can also play a role in determining a company's stock price. If the industry is experiencing consolidation, disruption, or decline, it may impact the company's stock price. Similarly, if there are strong competitors with similar products or services, it could lead to stagnant stock prices for TransDigm Group Inc. In conclusion, a combination of factors can contribute to a company's stock price remaining unchanged over time. These include stable operations, market conditions, financial performance, industry trends, and competition. TransDigm Group Incorporated market capitalization of $71 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that TransDigm Group Incorporated holds a significant advantage in their industry. TransDigm Group Incorporated trades at a higher price-to-earnings ratio of 41 times and a lower price-to-book ratio of -7.36 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 142% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, acquisitions play a significant role, with notable deals including the purchase of Jet Parts Engineering for $2.2 billion and Stellant Systems, Inc. for $960 million. Strong demand for air travel, particularly international air traffic growth, also contributes to revenue expansion. Additionally, increased aircraft production and deliveries by OEMs, as well as growth in defense spending, drive revenue upwards. Furthermore, organic sales growth of $149 million, driven by increases in defense sales, commercial OEM sales, and commercial aftermarket sales, is another key driver of revenue growth. The acquisition sales increase by $130 million also contributes to the overall revenue expansion. On the other hand, there are no explicitly mentioned drivers of revenue decline, although a decline in unallocated corporate EBITDA, as defined, is noted. The company's value-driven operating strategy, including obtaining profitable new business, controlling cost structure through productivity and cost improvements, and pricing products fairly, also plays a crucial role in driving revenue growth. The selective acquisition strategy, focusing on proprietary commercial aerospace component businesses with significant aftermarket content, further supports the company's revenue expansion efforts. The financial performance of the company underwent significant changes between two periods. Net income decreased from $493 million to $445 million, indicating a decline in profitability. This downward trend was also reflected in profit margins, which saw a substantial decrease. The net income margin dropped from 24.6% to 19.4%, while the gross profit margin declined from 61.7% to 59.2%. Additionally, income from operations, as a percentage of net sales, decreased from 24.6% to 19.5%. The EBITDA, as a percentage of net sales, also saw a decline of 0.5%. These changes suggest that the company's ability to generate profits from its sales and operations has been compromised. The reasons behind these changes are not explicitly stated, but they may be attributed to various factors such as increased competition, rising costs, or decreased revenue. Whatever the cause, it is clear that the company needs to reassess its financial strategy to improve profitability and restore growth. The company's financial performance is a testament to its ability to generate positive operating cash flow. The data from the past 2 years clearly indicates that the company has been able to produce significant amounts of cash from its core operations. In 2025, the company generated $832 million in net cash provided by operating activities, a substantial increase from the previous year's figure of $752 million. This upward trend is a positive indicator of the company's financial health and ability to manage its resources effectively. The consistent generation of positive operating cash flow suggests that the company has a solid foundation for future growth and success. With this strong financial footing, the company is well positioned to invest in new opportunities, pay off debts, and reward shareholders. The company's debt level and interest expenses have undergone significant changes over the past year. While total debt has remained relatively stable, gross debt has increased from $29,322 million to $29,541 million. Long-term debt has also seen a slight increase from $29,167 million to $29,197 million. In terms of interest expenses, there is a notable increase of 26% or $97 million in interest expense, net from 2024 to 2025. Accrued interest and interest expenses have also increased significantly. However, some pages suggest that no significant change can be determined in interest expenses. Nevertheless, the overall trend indicates an upward movement in interest expenses, with a 25.7% increase in interest expense net to $475 million. The company's performance can be summarized as follows. The commercial aftermarket sales and OEM sales demonstrated strong growth, while defense sales also showed significant improvement. Within specific segments, the power and control sector experienced a notable 19.2% increase in sales, followed closely by the airframe segment with a 7.9% rise. In contrast, the non-aviation segment struggled, posting a decline of 21.2%. Management's vision for the company is centered around becoming a leading global designer, producer, and supplier of aerospace components. To achieve this goal, they are focused on securing profitable new business, controlling costs, and pricing products fairly. In terms of financial management, the company aims to meet its current debt obligations through internal funds or refinancing. Excess cash will be allocated towards strategic initiatives such as capital spending, acquisitions, dividend payments, and stock repurchases. Additionally, the company plans to make strategic business acquisitions, pay dividends to shareholders, and invest in its own stock when market conditions are favorable. Overall, management's strategy is geared towards driving growth, managing costs, and creating value for shareholders through a combination of organic and inorganic initiatives. The company's financial activities have been notable for two key initiatives. Firstly, the company has a history of paying out dividends to its shareholders. This indicates that the company is generating sufficient profits to distribute a portion of them to its investors. In addition to dividend payments, the company has also engaged in share buybacks. By purchasing back shares from the market, the company can reduce the number of outstanding shares and potentially boost earnings per share for existing shareholders. Concerns have been raised regarding the potential for inventory buildup and supply chain disruption. The company's decision to increase raw materials in anticipation of fiscal 2026 sales demand has led to a significant cash outlay of $96 million, which may indicate an overstocking of inventories. Furthermore, the company has identified supply chain constraints as a potential risk factor, suggesting that there are concerns about its ability to maintain a smooth flow of goods and materials. This could have serious implications for the company's operations and profitability if not addressed promptly. That concludes the financial summary for TransDigm Group Incorporated. Feel free to comment below, and I will be happy to answer them when possible.